Assalamualaikum, my name is Dildarman. Welcome to my YouTube channel. I'm here today with you guys with some important topics of investment analysis. We will learn today here some important topic of investment analysis like standard deviation, geometric mean return, arithmetic mean return, and last one is expected return. All of these topics we will perform in MS Excel. We will learn how to calculate these all of these in MS Excel with the help of formulas. And I hope that you will understand in the last of video. So let's start the video. So let's start the video. Here is the question about these topics. As I early said that we will perform these with the help of examples. So here is the question that we will perform in MS Excel. So question number one is during the past 5 years you owed two stocks had that following annual rates of return. So there are the two stocks, stock A and B. Their returns are given of 5 years. In A, we will to compute the arithmetic annual rate of return of each stocks. So let's start the video. As I said that we will perform it with the help of examples. Here is the question. We perform it in MS Excel and solve these topics. So and number one question, during the past 5 years you owe two stocks that had following annual rate of returns. Stock A and stock B. The rate of returns are given for the 5 years for both of stocks. And A, compute the arithmetic annual rate of return for each stock. Which stock is most desirable this year? So basically, compute arithmetic rate of return for both of stock A and stock B, and then we have to suggest which is most preferable or desirable on the basis of arithmetic mean return. So let's start solving these and this question. Here is the stocks data are given, and we have to calculate arithmetic mean return. For the arithmetic mean return, we have formula. The total of holding period yield holding period yield divided by the n means number of years. For stock A, the total of holding period yield is 0.27. How we will calculate there here? Let's see. We have put a formula is equal to sum the total of this row. Stock A is return. We have taken the total of these returns for the 5 years, which is the total of holding period yield. Then the n, we have taken n. N means the number of years, which is 5. Then we will calculate arithmetic mean return for the stock A. For this we have divided the total of holding period yield with the number of years. So in this way we have got the answer 0.0554 arithmetic mean return for stock A. In this way we have calculated for the B, which is 0.016. Stock A is more desirable because the arithmetic mean annual return rate of return is higher. We prefer or we suggest to the investor that stock A is more desirable on the basis of arithmetic mean return. So now we move forward to the second question. Let's see. The A we have done question A. Then we are going to the part B, which is compute the standard deviation of annual rate of return for each stocks by this measure, which is preferable stock. In this question we have to calculate standard deviation for both of stocks, and then we have to suggest which stock is most desirable. So let's start the calculation for standard deviation here. Basically we have book formula for this standard deviation that we this formula. But in MS Excel, we use some different formulas to calculate standard deviation here. Look how I have calculated this. For calculating standard deviation, I have put formula is equal to STDEV point dot P. Then we have selected the row, the returns for the stock B. Look here. Then I have entered. The answer is here. In this way, we have calculated for the stock B, and for both of stocks we have got the standard deviations answers. For stock A is 0.115. For stock B is 0.057. By this measure, B would be preferable because the deviation in P is lower. We suggest which is desirable on the basis of low deviation, which mean low risk. Now we are going to the part C. Look what is the part C says. Part C, compute the geometric mean return of the of return for each stock. Discuss. Sorry, we'll discuss difference between the arithmetic mean return and geometric mean return. Okay, we are solving this here. Now we have to calculate geometric mean return. For calculating geometric mean return, we have formula. This formula where this sign is indicate the product of annual holding period returns as follows. Like we multiply the all of holding period returns with each others. Then we divide it with 1 upon n. This is formula. Then we minus 1. So get holding period rate, what we have done? We have done 1 plus the holding period yield. We have done this one. We have a plus when all of return for the stock A here. We have put formulas. Then we have got the holding period returns. Then I have done the product formula, like I multiply the holding period return of 1 year with the second, then all of these I have multiplied with each others. Then I have got this answer. To calculate geometric mean return, what I have done, then which answer I got? I put simply this formula 1 upon n, that one 1 upon n. I have for getting 1 upon n, I 1 upon c 5, which mean year. The answer is 0.2. So in this way I got this answer and this answer, sorry, and I minus 1, so I got geometric mean return. In this way for stock B I got 0.014. Stock A has more variability than stock B. The greater variability of returns, the greater the difference between the arithmetic mean return and geometric mean return. Now I move forward to the second question. Let's see what it says. It says a stockbroker call you and suggest that you invest in XYZ company. After analyzing the annual report and other material, you believe that the distribution of the expected rates of return is as follow. Here is the data, rate of returns and probability. Calculate the expected rate of return. Now we have calculated. We have to calculate expected rate of return on the basis of this data of XYZ company. So let's start calculating expected rate of return. To calculate, we have formula. In this formula, we multiply the probability with the rate of return. With the help of this formula, I have calculated the expected rate of return. I've multiplied the year 1's probability with the rate of return of year 1. Then I simply put plus. Then I've in bracket I've calculated the rate of the probability of year 2 with the I multiplied it with the rate of return of year 2. In this way, we will calculate all of these numbers. I've got this answer 0.075. So expected rate of return is 0.075. So let's start third number question, which says discuss the three components of investors' required rate of return on investment. So let's see which are these components. First one is risk-free rate. This is theoretical return on investment with zero risk. In practice, it is often approximated using the yield on government securities such as treasury bonds. Like this is a basic return which investors expect from their investments without any the basic return which is beside with the risk premium or inflation premium. The B is inflation premium. The inflation premium is added to the real interest rate to the account for expected inflation rate. Means in the increase of prices of goods, something or machineries, like in a country there is inflation rate. The inflation is increasing day by day. So in the investors expect inflation premium on the basis of rate of inflation. And see, the third one is risk premium. In many investments, there is a uh, the risk is attached. So the bigger risk the investors expect, the more in return. So this component is also considered by the investors. Now we are going to solve the fourth question. Give an example of liquid investment and illiquid investment. Discuss why you consider each of them to be liquid or illiquid. So let's see. There are two examples I've taken. For liquid investment, there is an example shares of large public companies. How they are liquid? Let's see. We are free to buy and sell the shares of large companies. Formerly, we go to the stock market of any country. We easily buy and say of the bigger companies which are listed in the stock market. Its share we purchase and then we sell easily at a time, any time, and which are more liquid. So I've taken this as an example of liquid investments. For liquid investments, I've taken the private startup equity. Like we are going to invest in some private equity company, which is a like a startup. It is very difficult to sell its share or its part of equity at the current time. It may take some time. Maybe it sold in within hours. Maybe it can take years. So these are two simple example I've taken for liquid investment and liquid investments. In last question number 5, we have question that you own equity in the Alpha company and you read its financial press that a recent bond offering he raised the firm's debt to equity ratio from 35 to 55%. Discuss the effect of change on variability of firm's net income stream, other factors being constant. Discuss how this change would affect your required rate of return. So let's see. Very simple to understand this question. The increase use of debt increase fixed interest payment. Like we are going to borrow some loan, then we have to give against it the fixed interest rate. Since the fixed in contractual payment will increase, the residual earnings net income will become more variable. Means if we are going uh, give some more interest to the company, then our income will vary from higher to lower or lower to higher. We are not sure about net income when our debt ratio increased. The required rate of return on the stock will change since the financial risk uh, as measured by the debt equity ratio has increased. Definitely, when our income decreased or increased, we are uncertain about the expected rate return. It also the net income also affect the expected rate of return. So it was all about today's topics. We've learned many important topics about investment analysis. Thank you for watching and being attached with me. I hope you understand the topics I teach here. Thank you for watching. Allah Hafiz.